your last name?
Sue.
Sue.
Yeah,
It's
Sue.
not Shu.
Sue.
Sue.
Yeah.
That would be SHU, like everyone who you call to book a showing for, when they're like.
Yeah. And the worst is when like they asked me, can I?
That was when I used to have to book the showings for when I was like the new bitch boy at like Makeworks in the basement. I would have to book showings for I think even Billy at one point, and I would call and book, and I'd be like, Billy Hsu,
HSU,
and they'd be like SHU.
Yeah. I know those days.
How about when they go, you go HSU, and they go, can you spell that out for me? I'm like,
It's 3 fucking letters.
HSU. They think it's a weird last name.
Yeah.
HSU.
Let's say law too.
Yeah, LLA.
Yeah.
And they're like
LAW?
No, LA.
True. Yeah.
Or they'd always pull up some guy from like Home Life. And I'd be like, no,
No.
that's Simon LAW. Fucking
Like Home Life? No,
roll
no.
it back.
Urban Village Realty.
Yeah. I'd be like, what the fuck is that?
Damn, we all went through the same experience practically.
Yeah, exactly.
It's pretty funny.
Or Your Choice or whatever.
It's like 3 generations of the same person.
Yeah.
Very different people. It's
I mean,
Kind of.
kind of all look the same
I mean,
right
pretty
now.
similar. We're wearing different shades of blue.
This is like
50
what's that?
Shades of
Like
what,
Matrix.
yeah.
Matrix,
So
yeah.
there's like different iterations of the same
We have
person.
the Italian version, the Chinese version, the Greek version of the same person. Oh, man. Yeah, it's been a while. It's nice to have you back on here.
Yeah.
thanks.
Where are you? Episode 2? 3?
Something like that.
Something?
Yeah, you were back in the OG days. It's
And
a lot
we were
different
in
now.
the same booth,
Same area,
which is
kind
just
of.
a whole lot upgraded.
We were drinking some
upgraded.
beers. That was fun, actually.
Yeah, it was.
We need a table in here.
We
now.
should've-
We need a table so we can or side tables.
We should have brought some beers.
Yeah, we should.
It's
I
way
think
too
we have some
early on a Monday
downstairs.
morning.
Monday,
It's
though.
like
It's
Monday.
It's
Monday,
like
though.
2 o'clock,
It's
but
2
it's still a
o'clock on a
Monday.
Monday.
But it's
This
like a
is-
holiday Monday.
No,
sort of.
it's not
The
acceptable.
5th of
I
December.
like how you guys try to
that's-
justify things. It's like
No.
Monday, but it's kind of holiday, so we can pull it. So
That
it's
was
okay.
him, man.
If I was in an airport, it's okay.
That's true.
It's 5 o'clock somewhere, whatever.
Yeah.
No.
We're not going to be drinking right
Have
now.
showings
I have
later.
work.
Yeah, I got
Yeah.
showings
Oh,
Good
man.
call, guys. Good call.
Yeah. How have you been, man?
I've been good. I've been very good. I don't know in terms of good and like friends are good, family's good, work's good.
It's the most important. Well, not work. The friends and family
Yeah.
part is the most important.
Health is good. Yeah,
Health.
yeah,
Health is good.
yeah. So
That's good.
yeah,
You're like on that semi-retired life now.
semi-retired life.
Yeah.
Living looks.
Well, to recap, so the last year and a bit, maybe 8 months, you've been now managing a couple bigger projects on your personal side.
Yeah.
With properties.
Were you finished? Were you currently at that point? I don't remember.
What do you mean?
His current house, like his.
No, his current house was finished.
Was it finished then?
Yeah, his current house was finished. So he was working on the 2 current ongoing projects.
Yeah.
And then at that time, you pretty much took a step back and said, just focus your energy there.
Yeah.
Pardon me?
Was that the mindset? Like, so what happened was a couple, what was it, 8 months ago, took on a pretty big project here, close to the office, total renovation. You can talk to us about that one in a bit, but and then at that time, and then you took up the other partnership project, which again you guys are going to talk about as well, most likely. At the same time, you kind of took a step back from your actual job, and you were kind of like, had other things to manage, took the step back. So that's why I said, semi-retired, right?
I wouldn't say semi-retired. It's just so this year it's been a little bit slower.
Yeah.
The market's been a little bit slower. So, and that with conjunction of me taking or working on other things has, I wouldn't call it semi-retired. It's just the market's been slower. I've been focused on some other things too. I'm still working though.
You get the ability to choose where you put your focus,
Yeah.
which is nice. Is nice.
So you're making a comeback, is what I'm hearing. 2023.
Comeback tour.
Yeah, that's right. There you go.
Hell yeah.
How are your projects going right now? So your first one.
Where's on it?
Oakwood. There's across the street from the office, actually. Yeah, so that's going pretty well. What do I have to say about that? It's going quite well. Originally, in terms of the numbers, how I projected them, and how things have turned out because of the rent increases in Toronto.
Yeah.
And how I ended up, carving up the place.
When did you start that? When did you lock that deal in? Just so I have an idea of like where the rents were at when you first
locked it in?
Yeah, like when did you firm up the deal?
It was just after my birthday, actually.
Whoa.
Yeah.
So that's like March, April?
In March, yeah.
Okay.
So I bought a looking back, it's pretty much at the peak. I would say.
But rents have done a number too. Rents have come up quite a bit.
Probably 20%.
That was like near, like
prices fell about 20%. But you got a pretty good deal.
Yeah, I got a fixer upper, so there was a bit of a cushion there at the time.
Yeah. Fixer upper on a main street.
Yeah, on a main street too. Yes,
there was that discount, I guess, that you purchased it. I remember at the time you were like, I can't believe I picked up this property for this number.
Yeah,
sure.
And now, honestly, your number probably still
not like
still
absurd.
hold. Yeah.
No, so that's part of buying these fixer uppers is that you get a bit of a cushion, right? So it doesn't instead of buying if at the peak, if you bought a finished product, brandly new, when the interest rates were super low and everyone's bidding, compared to where it might sell for today, you would have taken a steeper short-term hit, I guess.
Yeah.
Versus buying the fixer uppers and where there's less competition.
Yeah, you pretty much purchased the biggest fixer upper on a major road in the neighborhood at the time.
Yeah, so I guess there were some discounts there. Yeah, but I was going to bring up the point that if I had waited, I might not. If I had waited, I might not have qualified for a home because
given the rates,
when you look at your portfolio at that time, the numbers made sense to the bank, the numbers made sense to me. It works, right? However, fast forward 5-6 months or whatever it is, now my portfolio is more expensive to carry. The banks see that too. I might have been able to qualify for what it was. And here's another thing that a lot of people don't take into consideration on the investment side. When we borrow on a variable rate with a bank that's willing to extend your amortization if the rates go up, actually the numbers are still relatively the same in terms of cash flow. You're not paying down your principal as much, but in terms of your overall debt obligation, your debt obligations are relatively the same still.
Yeah, so, just a longer payback period.
Yeah. It's just to extend your amortization. That's a bit of on the investment side. People don't realize is a bit of an advantage.
Yeah,
it is a bit of an advantage because if you're purely an investment portfolio, if you just look at debt obligations, if they extend your amortization and you're not required to pay back more debt in the same amount of time, it's actually the same thing.
Right, as far as a qualification.
Yeah.
Very powerful tool.
So understanding when you get a variable rate, especially on investment property, you might want to make sure if you're working with a bank that says, if interest rates go up, instead of us asking you for more total debt, we'll just extend your amortization. So that's something to consider when you talking to the banks.
That's when people talk about trigger rates all these days. These days a lot. It's what are the terms? Fixed payment versus fixed amortization. Right, I believe. Fixed amortization being every percentage the rate goes up, your payments are going to go up with it to keep your, let's say it's 50% principal, 50% interest. That ratio will remain the same, so therefore your payment's going to go up each time. Versus like the fixed payment, your ratio of interest to principal is going to change until you get to that 100% interest, which is then where you've heard the term a lot lately, trigger rate. Then your payments go up. You're paying 100% interest, but from a qualification perspective, from a cash flow perspective, it makes things a lot easier to carry and to continue to scale.
And it gives you some holding power, which people don't realize. So so it is important when you're getting a variable rate to make sure you understand if you're on a fixed amortization or a fixed ratio, as you say. So.
And did you understand that when you were buying this property? Was that something you kept in mind, or was that just a happy coincidence of what ended up happening? Because I know for myself, when I purchased a year ago, I didn't. Well, first of all, I didn't foresee the interest rate to go this high this quick, so I wouldn't have even thought. If you asked me whenever, and I still believe in this, what's going to perform better over a 5-year period, a variable or fixed rate? I'm pretty sure it's going to always be the variable rate. Except last year, I could have had a fix for low 2s, or whatever it was, mid 2s, low 2s. Where I think that was the big winner, where some people took that. I think that's maybe in history that will be the biggest win piece, unless rates go down. But again, even if they go down, I don't think they're going to go back to what we saw at 1.45 for a mortgage, 1.5 for a mortgage.
So we might get that kind of interest rates if there's some sort of world crisis again, where they have to lower interest rates
they had to keep liquidity, keep money moving,
and keep the economy kind of going.
Yeah.
So because we don't want all of a sudden. Yeah, so usually when there's a crisis, they lower rates to keep the economy kind of going. Sense.
True.
Yeah.
There's a lot of lessons I took from like the last 2 years, let's say, just in terms of in that regard. But like to your question earlier, at the beginning of the year, the thought of a fixed amortization, fixed payment, that whole, like, I didn't even realize that there was multiple different types of variable mortgage, right? And I didn't dig. I wouldn't have given it a second
there's no
question
reason to,
regardless, right? I wouldn't have really looked at it a second time. Fixed, the variable versus fixed has always been a question. What are my plans for the property? When do I want to refinance? All those types of things. Never, these days, now having gone through the last year and seeing how that's impacted a ton of people, that's going to become a thought process a little bit more, right? The payment versus the amortization when getting a new variable. What's your plan for the property? Am I with the right lender that's going to put me in the right kind of variable? It's a new tool, new question to ask.
Well, things got a lot more. Like if you go back a couple years, anywhere during the COVID period, even the years before that, people were just buying as quick as they can, no matter what they can for whatever price they could. It wasn't really.
Who's going to give me a mortgage?
Yeah,
all right,
you got me a mortgage? Great, I lock up the property and that's it. And I'll figure everything else. I think nowadays there's a lot more reverse engineering that needs to happen. You start with what are my options? What do they give me? Can I even qualify? That's the biggest question nowadays is, can I even qualify? Because I think a lot of investors now, a lot of people in general, just can't, or it's much more difficult. I'm going through that process right now with myself, with clients, and it's all a world difference of what it was even 6 months ago.
Yeah.
Right?
Well, I mean, you look at we saw this was going to happen, but didn't expect it to be this aggressive. But like when you look at a year ago when you're qualifying, the qualifying rate being 5.25 at the time, when it's 5.25, or your rate plus 2%, I think it is, the higher of the two. The base rate is higher than 5.25 these days, right? Yeah. Plus the 2%. Like a lot of guys are qualifying. Your like stress test rate is 2-3% higher than like what it would have been before,
which is insane.
It's
for
huge.
$1
$1 million.
Property.
That makes such a huge impact.
Yeah, where it used to be like 5.25,
5.25,
5.25. Yeah. So big difference. Was that something? Okay, long-winded. But was that something?
So going back to the original question, I was aware of how fixed amortization versus fixed payment. I was aware, and that's why I did go with these lenders, because I do believe in cash flow being the most important thing because overall debt obligation. So in the same way that I prefer HELOCs because HELOCs is interest payment only, right? You can carry more by just paying off interest as opposed to interest and principal, right?
Yeah.
So and from a traditional real estate investment portfolio view, you would ideally stay as leveraged as possible. So again, you're just looking for cash flow. So yes, I was aware of that. However, I was not expecting interest rates to go up as fast as it did. I was aware of I was aware of what I wanted out of that mortgage in terms of being extending your amortization in the case of this happening, but I didn't foresee this happening though.
Right.
Yeah.
And how have you weathered during that period now?
How have I weathered it? I guess like everyone else, I'm just for my personal portfolio, because the thing is, because I'm on these variable mortgages that allow for extended amortization. It's been okay in the sense that I'm just not paying back my principal at the moment. But I've been triggered a couple of times for minimal amounts. But overall, when you look at my debt obligations versus my gross income, like things look pretty good. They look fairly healthy. And this is because of I talked about this before in the defensive investing, right? Yeah. You want to have a strong cash flow in the case of this happens. Like a lot of people we're saying buying any price, get me a mortgage. This is like the condo market, right? It just goes up. Everything goes up. We just buy it, right?
The good old number goes up. Investing.
Yeah. Well, now the market needs to correct itself, and everyone has to redo the math, and we see whose math works and whose math doesn't work. So that's what it is. And right now, we're being honest. The condos math doesn't work that great, to be honest.
Yeah,
right.
It's a little bit different.
Yeah, we were talking about this earlier.
Well, I think
the condo math wasn't that great to begin with.
No.
And now we have increased interest rates. So some of these condo investors, we'll see.
We'll be hurting a little bit more. But I think it also goes back to the point, though, that what we do and what people with the Burr method or what people who are okay with taking big projects do, handling with more tenants, handling multi-family homes, it's a lot bigger of an ask for the average person and the average investor.
Sure.
Where a lot of people, and I know I work with a lot of clients that are in this mindset, and it's, I want to buy this so that my kids have a place.
Yeah. It's not short term.
It's not short term. Yeah. It's not to grow a giant portfolio. It's not to, do whatever it is. It's not to cash flow. They have good, stable jobs. They make a lot of money. They have disposable income. They want to buy 1 or 2 properties that they like so that they're proud of. Right there, that term, I like the property, it means you're not going to cash flow a lot. Unless you're in the mindset like you are or like we are, where we're looking for hyper.
Cash flow.
I like cash flow, yeah.
I like a property that's going to cash flow. But that point, and I've heard clients say that as well, is like when you get kind of emotionally attached to the neighborhood, to an extent, neighborhood is important. To an extent, you don't need to be like super AAA in the annex because it makes you feel good. But like, I like the location. I like that it's detached, and I like the finish style. A lot of the time, that puts you way over into kind of like the end user who actually cares about emotions.
Because those are the other people who like emotions,
to a point where the investment math doesn't necessarily make as much sense, right? And that's not as defensive an investment.
So that's where you're right. So, but if you like the property and you like it, and that's all good. However, in terms of like traditional sort of investing metrics, and the fact that if you want to grow a portfolio and want to work with the banks to grow a portfolio, you have to keep cash flow in mind. You have to keep these things in mind.
Right? Yeah. So for sure. Yeah. So I think like overall, I mean, different investors have different mindset, different goals. Yep. Doesn't necessarily mean condo's bad. Doesn't necessarily mean break even's bad or negative's bad. It's just what your end goal is and where you are right now.
Yeah, if you put it like that, then if you're meeting your own goals in terms of investments, then that's fine. That's
exactly
cool. Yeah, if you're meeting your own goals, and everyone has different goals, different criteria, and what they're looking for. So
I think nowadays too, more than before, is in Toronto specifically. I don't know about other cities, but in Toronto, if you go back 2-3 years and prior, the entry point for a property was 700, maybe something like that, or close to around that range. You can probably pick up some, semi-detached that needs some work or whatever. Yep. So let's call it 700, and mortgage rates are at like 3.5%, maybe. Times were different. Rents were similar, I would say, 3 years ago.
Pre-COVID,
I would say they're pretty similar to pre-COVID numbers now.
I think they're a little higher now.
They might be a little higher.
We had this chat, I think, last time. I think the bigger units are kind of maybe just now ticking over, ticking a little bit beyond. The smaller, the 1-beds, the bachelors, even the 2-beds, I think have kind of rocketed past where they were prior to.
So let's just consider the same, just for argument's sake. But you're entering a market at a time where 700, let's say, is the entry point. Your mortgage is 3.5%, and rents are at around what they are now. You fast forward 5 years. Now the entry point is 890, 880, maybe around there, 900. Let's say 900 to be more comfortable, right? So you're at 900, 200,000 more. You're at 5.5%, 6% interest, right? And rents are the same. That's your cash flow. That's more than your cash flow on those properties 5 years ago. So a lot of people now, so let's say you're just getting into the real estate game now, and you're thinking, I've saved this much money. I've saved $240,000, $230,000. I have a partner that I'm working with, or me and a couple of my friends are going to pool our money together and get into this game to get in at that ground level. And now we're not talking about having a budget of $100,000 to renovate, right? We're talking about, this is all the money I have, $230,000, $240,000. How do I own real estate? Because I believe in real estate in the long term. You're going to have to be okay with not cash flowing positive or being very close to break even or in and around that area, because the cash flow positive, even back in the day, but now especially, are mainly from value add projects. And value add projects, you're going to need to have a budget aside for renovations. You're going to need to take on more of a risk that a lot of people aren't okay with. So if you're a first-time investor nowadays and you just want to own real estate, it might not help you grow as fast. It might take you a little longer. It's going to take you a little longer in general these days, just because the way things are, unless you have that, you made a purchase before and it went up in value and blah blah blah, it's going to take you a little bit longer. So when you're getting into the market now, I think you have to look at your options a little bit more if it is in Toronto, unless you have that big renovation budget. Does that make sense? It was a little long-winded.
Yeah, I think in general, what you're saying is you've just if it's going to be fairly close to turnkey, fairly close to low renovation, a little bit of lipstick here and there, expect neutral or a very small cash flow margin. Where you're going to find the deeper cash flow properties these days, it isn't a big reno, a fairly significant reno, or like you're diamond hunting essentially, which to be fair is kind of what we're good at.
Yeah.
We do find diamonds.
Yeah.
But most of the time they still need a lot of work.
Yeah, the diamonds still need a ton of work.
It's good, and it's a deal. It's available to us to pick up because nobody else really wants it, or they can't see what it can become. Right? They can't see how to kind of densify that and make cash flow out of it.
Well, that's something that Billy, you've been really good at over
Billy's
the years.
pretty good at making cash flow.
Yeah. You found a few diamonds in the last 3-4 years.
That defensive
maybe.
Investing. When I look at the stuff that you've got a couple together, the cash flow margins are very healthy and provide the ability to weather. I'm not stressed about anything that we own, right? Just because of the margins are pretty thick.
So let's talk about Oakwood now.
Sure.
So Oakwood, you said you purchased it, let's say late March.
Yeah.
When did it close?
Closed, I think it's May. I think I gave it 2 months, or it might have been a month and a half. Around May, yeah.
So closed in May, and pretty big renovation project.
Yeah. Entire interior down to the studs, more or less. Exterior, new windows, new doors. Probably be throwing in a roof or some roof work as well. Didn't need to waterproof it. Pretty large project. No major structural changes though.
Are you interior waterproofing or no? Nothing?
No, there's no waterproofing on this house. So
okay.
Yeah.
And no moisture.
So the inspection came back that it wasn't required, and from what we've seen from taking out some of the drywall in the basement there hasn't been any sort of evidence of large leaks. So
I think a lot of stuff. I mean, unless you have an active leak or something that's kind of like starting to seep, you can do a lot with a little bit of preventative maintenance, right? Make sure the downspouts are away, things are graded properly. You seal up anywhere in between. You can do
dehumidifier in the basement.
So many people don't. Like, it's so crazy how many properties you go to and like the front corner, the downspouts just funneling into the foundation.
Yeah.
A little bit of preventative maintenance, a few $100.
Yeah,
so
true. Yeah, that's true.
Saves you thousands in the long run,
Like
and the integrity of your structure.
Yeah.
So it's huge. So what's your overall budget? A rough estimate of a project this size, where it is very high value add, very high. Cash flow will be very healthy.
I have to do the numbers again where I'm in the cash flow, because I haven't ran the numbers since I guess two more recently because of all the rate hikes. Because regardless, I'm stuck with the property anyways, so I'm gonna follow through.
Why stress yourself out?
So I'm pretty sure it's gonna be okay. I just have to run the numbers, see where they're at. In terms of budget, I think for this project I'm doing. I think I'm gonna land somewhere like 125 to 150 maybe in that range. Good. Yeah, that's pretty good. I would say. I think I just again
for the amount of work. This is a project that's taken months.
Yeah, so it's May, so it's going on 6 months. It's gonna be a dead month this year, but hopefully I'll be up and ready to rent out the early spring kind of thing. But yeah, no, I think that's for me in terms of where I want to be. It works. The numbers work. Within that budget, and that's where it is, kind of thing.
Nice. And so your property is going to be split into 3 units.
3 units, that's right. Yeah.
And 2-bedroom.
So yeah, the top floor top floor is two bedrooms. Main floor is 3 bedrooms. Basement is 2 bedrooms as well.
Nice.
So, yeah.
Big property.
Yeah. This looking from the outside doesn't look that big, but there's a bit of an extension at the back there. So in essence, it's more like a 2.5-story kind of building with the extension. If you factor that in, and that's with a lot of these Toronto homes. Like a lot of times, like it is dime hunting. You have to see these.
Yeah.
We talked
You
about
gotta see them in person.
Yeah,
Yeah.
we talked about this before. You gotta see these properties in person. They've been 100 years old, right? How many iterations? How many renovations?
Yeah.
How many
How
additions?
many levels of addition?
Yeah, exactly.
You see the brick line, like
What's the
1, 2,
basement
3.
looking
gotta-
at? Like
you gotta
it's like
visit.
all that you can't tell from the listing.
And that's yeah, the only way to tell if you're getting or what the property actually is in Toronto, in downtown or older Toronto is you gotta see them in person. So
For sure. That actually is a perfect kind of segue into Lightborn.
Another addition.
Another addition. So
I was gonna say that the sneaky addition has been like almost this free value
Sure.
on a lot of the deals that I've looked at or that we've like that our team has tied up personally or for clients in the last, I don't know, let's call it 6 months. Like the best stuff that I can think of recent memory, barring one beast in particular, most of them have like this sneaky addition that you kind of can't tell from like the photos, from the listing. But when you go see the house, they've got like an extra bedroom at least worth of space.
Yeah,
on
that's the
2
big thing.
or 3 floors. And they're priced against their neighbor competition without the addition.
Yeah.
Right. They're priced fairly similarly. So you've got, we talk about defensive investing and adding cash flow and blah, blah, blah. What's an extra like 1 bedroom per times 3 units?
Yeah, it's a lot of money.
That's a massive amount
yeah,
of cash flow.
it's like $400 a unit
Yeah,
at least.
that you're
So,
maybe you pay a slight markup because it's a little bit bigger, but like
For an extra 1,000
for
plus.
the most part, yeah, you're still more or less comping it against the neighbor, right?
Yeah.
So it's a huge value bump.
yeah, definitely. So
so going back to your thing with Lightborn, the same thing. We went to check it out, and we noticed there's an addition that also went down to the basement, and we ran the numbers on Lightborn. It's like, wow, this.
And for reference, this property I also saw with clients beforehand who now have since bought. They did not want that property. Mm-hmm. They walked in there and they said, "Get me out of here." And
those are our best deals.
and just for reference, though, I mean, it sounds easy. I walked in there and I said, "Whew." Like, and I've seen every property, right?
Yeah.
And I know you guys probably went, "Ooh, this is a big job too." I mean, you weren't scared from it, but it's a huge job.
Well, it's all math, right?
It's all math. You know the final product, like what's going to happen when you're done the renovations. You've done it 100 times, 1,000 times, 1,000,000 times at this point.
Probably not 1 million.
Probably not 1 million. Probably
not 1,000.
Yeah. But let's say hundreds of
it's
times.
A handful of times.
Yeah, a handful of times.
Enough,
a couple times. Been around the block.
Yeah, enough that you know
what to expect.
From
Yeah,
yes,
exactly.
Kind of thing.
So for someone in your position, in my position, as a seasoned real estate investor, you might look at a property like that a little differently. You might be
that's true.
Scared to go in the basement, but you'll go in because you know what lies ahead in 6 months after the renovation's done. With clients that are newer, with clients with a smaller renovation budget, with newer first timers for sure. Depending on who they are and depending on what their goals are, they see a project like that and they go, "What the heck am I supposed to do?"
It's true.
And even the thought of doing it is just, I have a job. I don't want to, I have my other. I have kids. I have whatever it is. I have other bills. I don't want to worry about this.
It's not a small project to
It's
manage.
not a small
like
project.
Those types of projects aren't small.
It's a
projects
large
to
project,
manage.
and it takes a select few people to really capitalize on a project like that. And it takes a select few people to actually appreciate the neighborhood as well. Not meaning appreciate it being like, I like this neighborhood. I mean actually gain appreciation and value by the work that you're going to put into that neighborhood. So there's a lot of neighborhoods in Toronto
stuff to do.
Exactly.
You don't go too far over, but you also bring it up to like
you bring it up
the
to
top
good,
5%
exactly
of the neighborhood type of thing.
And these homes don't do that themselves. It doesn't happen overnight. You don't have a house that somebody's been living in for 60 years and then they pass on or whatever happens and the property hasn't been touched for 60 years. It looks like it's from the 70s or whenever, right? 60s, 70s. It's in very poor condition. It's falling apart at this point, and their neighbor is a beautiful new renovation. But what's going to bring that house to that level? It's either going to be an end user going in and dropping in hundreds of thousands of dollars and just spending on it. But for the most part, most neighborhoods in Toronto aren't geared towards that. There are a handful of the premium ones where someone's going to look at it and say, "I'm going to buy this for 1.2 and put $600,000
because
it's going to work."
I'm going to die here.
Because are you going?
Yeah. There we go.
Okay, so for the third time now. So Lightborn, it's not the type of property that is geared towards end users in this current market, in the current location, meaning it needs $200,000 worth of work. It's in a up and coming location, meaning it's very trendy, it's very new, it's very hip. A lot of young people want to get it as first time buyers potentially, but as a second or third time buyer, it's your family home. Now you have 2 or 3 kids that are 10 and you're looking to upsize or what. This is not the property. This is the first one. This is the one that you get into the market at closer to floor level, which is where you guys kind of got it for.
Yep.
And you are the type of people now, or we are, or seasoned investors are the types that are going to go in there, make the value add, make the property really nice to what the area should be, because a property that hasn't been touched in 60 years is going to look a little crappy, of course, but you're going to put that love in and just really increase the value of everything involved in that little pocket.
Yeah.
And to your point, the first time buyer that would have moved into the neighborhood, right? The rentos you don't have that cash.
No.
You don't have the capital to most of them. That's and some of them want to do the rental. Most of the potential buyers that are going to be first time, if you're going to buy something that expensive, or the total cost purchase plus renovation, you're probably going to be buying the finished product so that you can amortize all of it through a mortgage. You don't have the extra chunk of cash.
Exactly.
You're
borrowing
the mortgage, right?
So I think properties like that end up sitting, especially in this type of market now, and they're left either going to sit on the market vacant. They're either going to sit on the market until the market gets better. They're going to be in a pretty dilapidated condition as they are, and they're going to sit there. Or investors are going to go in and increase the value, make them livable so that we have more units in the city, because that, again, is the biggest issue, is that Toronto does not have enough affordable housing for anybody. So create that affordable housing, increase the value of the neighborhood all in one, while giving people a safe, good, clean place to live, I think is very positive.
No, we do, in terms of that sort of whole sort of...
like providing housing.
Or a value creation, whatever you want to call it. I think what we do here, sort of converting single-family homes into a rental stock, is good. And again, we don't create things that are like super expensive. Stuff we do is affordable. It's clean. They're safe, we do good work, and that's why we've had continued success over the years. And it's not just our portfolios that are growing.
Yeah, all of our clients'
portfolios are growing too, because there is a demand for rental stock, obviously, affordable rental stock. There's a demand for this stuff, and this is very obvious with this year's sort of increase in rents. Because if there wasn't such a demand for this kind of rental stock, then we wouldn't have these giant increases in rent. So.
Huge demand. And I guess, I know a lot of people like to paint the landlord as the bad guy, right? But in reality, to our earlier point, these weren't properties that anybody was buying. They're not this isn't the sexy house that I'm not taking this away from anybody when it's sitting on the market for 60 days and it doesn't want to move, right? Nobody's buying it. So therefore, we can turn it, we actually have an opportunity to turn it into something and go and provide housing where our government might not be doing so much. Although they are starting to come out with initiatives that are going to help the private landlord to provide more housing stock, right? To provide more multi-unit, where we've been previously very restricted in the city.
Well, to add on that point, adding more properties is very difficult, because the only way in the city is to build up practically, or you can convert these homes, and I think the general opinion of real estate investors, and this is to somebody who maybe doesn't invest in real estate or just hears the buzzwords on news, and landlords are evil, blah blah blah. There's bidding wars. It's all because of the investors. I think to say that when the time was 10, 20 offers on a property, or even nowadays, investors are typically not the ones bidding up the price to a crazy level, unless they aren't running numbers.
I would call them speculators if they are taking part in that process. We were all part of many of those multiple offer presentations, but during the peak of things, we didn't win too many, unless it was the not great ones, because we've got a line. An investor has a set of numbers that they work with. here's the we're going to work our numbers backwards, and there's the price we can pay for it, right?
Yeah. And we would lose a lot.
We would lose a lot because there's no emotion, or there's little emotion.
I think I was losing like 4 or 5 offers a week at some point earlier from the January to March.
A lot of for a period of time, like Jan to March, it was like, we're just gonna write it down. All right, here you go.
Yeah,
see what happens. And then it was like, you lost by $250,000.
Yeah, and it was like, well, who the hell's paying for that? That's probably not an investor.
Yeah,
no, I think that's the end user who's now it's an
end
user competition,
speculator, or someone in those lines.
The number go up, and anyways, I think a lot of it those days was cheap money, end user, young couples with early 6-figure jobs times 2. This is my opportunity to get into something that I can kind of live in for a long time. This is my one chance to step into these neighborhoods. And then that kind of breeds more fear of, if I don't do it now, I'll never get into this neighborhood kind of thing. And then that just kind of continues and continues. And now a lot of those are,
well, historically that's been true.
Quadruple your mortgage rate on a property that you were already kind of like pushing for to get into the neighborhood.
Historically, though, that has been true, is that you do want to get your foot in the door when you can.
Yeah.
As soon as you can. Because
over the long run, if they can hold defensive investing or purchasing, if they can hold, they'll be fine.
Yeah,
right?
In the long run, it should be still be okay, because the way that paper money is designed it devalues over time, no matter what, right? So you just got to give some time.
Yep.
So Billy, you have Oakwood, you have the other property now that you're working through, both big projects. Yeah. When those are done, what's your next step? What do you think? Are you gonna? Because now you have a healthy portfolio. Yeah. You're living quite comfortably from the outside. You said it earlier. Your family's good.
Yeah. Billy pulls up
good.
In a Rolls tomorrow in the office.
In a Bugatti.
Oh God.
So what's the next steps? Like, what do you think you're going to buy more in the next year or two? Do you think you're going to take a few years off? Are you going to try? Like, what's the?
So in terms of leisure, I'm a little bit more on the leisure side, I would say. However, in terms of work, just because I enjoy it and I believe in it, and I still, as someone who calls himself an investor or an asset allocator or a capital allocator, if you have money sitting around, I'm not going to let it sit in the bank, right? Or if I have access to cash, I'm not going to let it sit in the bank. And if I see a good deal, I'm going to try to make something happen. Try to either make something happen or pass to a client or something, right? So it's still valuable work.
Yeah.
And it's not just about me in the sense that like, if, say I have enough for myself or whatever, there's still other people relying on me or relying on you guys to help them reach that stage. Yeah. So it's the work still got to be done, and I still enjoy it. So it's all good.
That's the important.
So breaking news: Billy is not retiring anytime soon.
It's important you enjoy what you do.
Yeah. So I think, I don't know, in reality, just because the way I think and the way I believe money works, something like this I'll be doing for a very long time. Just because, again, just going back to, you just shouldn't let cash sit there for too long, right? Yeah. Especially when I can prove to myself this system and the system here in Toronto with this single family rentals, these things work. I can keep doing it, and that's what we've been doing. So, yeah. Maybe
there's a day the numbers don't make sense, but
so when so when the numbers don't make sense, and we've had these situations before when the numbers start not making sense, we kind of look elsewhere.
Yeah.
For a little bit, but every time they stop working, something happens and it corrects where the numbers start working.
Yeah.
Like 2017 numbers start really working. Yeah. We were losing back then too. And then something happened, it corrected, the numbers started working again. Earlier this year, the numbers numbers not really working again.
Yeah.
It had to lose a bunch. And then
you look a little bit, or you start to expand the view a little bit. Maybe you look into like build a laneway, build a garden suite. Does that make more sense in this market? And then not terribly long after we start to kind of look at that, if you think of like, I want to say like Bollinger Bands almost, right? Like things go up too far past, and then it kind of brings itself back down into this range. It goes too far down from the investor perspective. Numbers make too much sense, then things kind of bring themselves back up into this range, right? The price will kind of find a floor. Find a ceiling.
So I don't know. I guess real estate investors, they get a lot of bad rap on the media, on the news, saying like these people buy up all the houses or whatever. But we also help correct the market too, right? Yeah. But people like us who run the numbers on a bunch of assets and start comparing everything, we help correct the market, and that's part of the market being being free. So yeah.
We're not BlackRock. We're not.
Yeah, we're not
Open Door. We're not scooping up all of the properties on the market
that
to
huge
just
hedge
sit
fund
there.
that just said they're going to put in
BlackRock.
No,
There's another
BlackRock was Morgan Stanley.
Oh,
Morgan Stanley. Is way more.
So BlackRock they bought a lot in the States. Or no, they bought in Canada.
Did they?
Right.
I think it was Canada they bought.
I can't remember.
Yeah. I have to look it up. But yeah, Morgan Stanley is going to be looking to buy up in the U.S. So
Yeah. I think it was $1 billion worth of residential real estate they're going to buy. If that's not a sign, I don't know what it is.
Well, they're the same thing, right? They have to allocate capital right now. Cash or cash or yield in this case, it's kind of high, right? So that's where they're going to put the money to work. So,
any final thoughts?
Final thoughts on what?
Just life.
On life.
Oh Jesus, getting deep,
broad.
Also super vague.
If there's one thing you want to tell people who are listening, and just keep in mind there will be maybe 7 people that listen to this. So there's 7 people listening.
7 people listening to this.
His mom, my mom, maybe your mom, Simon's mom.
I don't think she's gonna be.
No,
listening.
I don't think so.
Final thoughts. I don't have any final thoughts. I don't know. That's
to be continued. I like that.
Okay, yeah, there we go.
I like that. To be continued.
Just
episode of the podcast. Name of the podcast.
I don't know. Here, final thoughts. Just because
right.
this is where, and it's genuine. This is where it's coming from. I think it's important to just be grateful for a lot of things. And I've made this talking point with both of you. Like, we have a lot to be grateful for. Especially, I feel like we're quite privileged in the kind of work we get to do, and we get to make a living in a space that's
quite fulfilling.
Yeah, exactly. And because I don't know how else to put it. I think it's quite a privilege. So, and then just be just grateful for the things. Yeah,
it's a good point. Grateful. We do talk about it a lot, and I think I'll echo it. It is important to be grateful. I mean, I feel like Gary Vaynerchuk right now, but like gratitude is important. Yeah, it really is. We should take a second, realize that we are privileged to be doing what we do, to enjoy what we do, and to be provided the opportunities that we have in doing. What we do.
Sir.
So therefore, give us a call. We'll give you some opportunities too.
Thank you, Billy. Thanks for coming on. We'll do this again for sure. And we'll talk soon.
All right.
Cool.